Hey everybody, today we have Chris Barrett on from Midwest CPA, and we're going to talk about what everyone has questions on around accounting and specifically quality of earnings or Q of E, something that's talked about a lot. So Chris, thanks so much for joining.
Yeah, thanks for having me. Happy to be here and talk about accounting for acquisition entrepreneurs.
Yeah, I think while it can be boring in school when you're learning about accounting, once you start to do real world applications, it gets a lot more interesting, as I'm sure you have some stories about.
Yeah, absolutely. There's a lot more to it than we need more accountants too. So if anyone listening to this is young and wants to get into accounting, we need more of you. So
Yeah, no, it's definitely an aging industry. So for those that don't know, Midwest CPA, they're one of the leading firms in the SMB entrepreneur space now for acquisitions specifically. They offer a number of accounting services for you, whether it's sort of pre-LOI when you're approaching an owner, post-LOI when you're doing sort of your deep dive M&A due diligence, and then post-closing as well for traditional bookkeeping services. So on the business buyer side, they offer you quality of earnings services, and then traditionally they offer ongoing service, bookkeeping, traditional accounting. Just to give a quick overview, so Chris doesn't have to give the commercial as he's done probably a million times. But for those on today listening, I think the big focus here is really kind of what is a Q of E, Chris, and how can it be a part of overall M&A transaction. So to start, can you just explain what is equality of earnings? What does it mean in the context of M&A, and why it's important?
yeah, I would like to start answering that question by thinking about why would anyone do equality of earnings, because that drives what ends up being in the report. Um, and the reason that someone does a QOV is because everything we're looking at in a QOV directly impacts purchase price. There's kind of three components that end up, in that calculation of purchase price. The first one is the thing that's most obvious to people is the enterprise value. So you're buying this business for a multiple of some measure, usually EBITDA or sometimes SDE. Those are the most common. And so a quality of earnings report is going to figure out what is that actual economic EBITDA of the business that you're buying. EBITDA means different things to different people. Um, in a QOV, what we're trying to figure out is what is that EBITDA measure that you can then use to project the business into the future. So we're going to make adjustments to maybe a reported EBITDA from the sell side to account for maybe there's some accounting errors. Maybe there's been changes to the business. Maybe you're going to be buying the business and now you have to pay yourself a salary or you're hiring a manager, right? We're going to account for those changes that are going to take place with you as the new owner of the business, and also correct for any errors so you know the actual economic EBITDA of this company. The other piece of that equation is the multiple, right? So there are lots of different things that go into the multiple of the business you're buying. In a QV, we're not going to give you the multiple to buy. Ultimately, it's up to you as the buyer. But what drives that is the various risk factors that surround the business you're purchasing. So QV is integral in helping you figure out what are some of the red flags of this business from a financial perspective and possibly operations and other things that you need to know going in, so your eyes wide open and you understand the company you're buying. The second kind of lever that you're looking at when you're calculating purchase price are there any liabilities that you're assuming when you're buying this business? The easiest measure there would be, is there any unearned revenue that you're going to be then responsible for delivering that deliverable to the customer post close? You need to know what those liabilities are that you're walking into, those debt like items. And then the final piece, and possibly the most important, because this is what kills maybe more deals than anything we work on, is working capital. So how much working capital should that peg be set to when you're buying this business if you're not including it in the deal? Making sure that you're getting compensated for it appropriately in the purchase price. If there's some seasonality working capital, helping you understand what line of credit you should be getting so that you have enough funds to operate the business post close. So all like three of those buckets are things that we're really deep diving in the quality of earnings report so that our clients understand the business they're buying.
And that's great. Yeah, that's a great breakdown for everyone. I think to give everyone an example, if you think about some of these adjustments, right? Let's say you're buying a company and there's an adjustment of $25,000 after you talk to Chris, right? Just on a math basis, if you're buying something at a 3 times multiple, you're going to overpay or underpay, depending on the adjustments, by $75,000, right? If it's a 4 times multiple, it'd be $100,000. So it can be quite a big impact. And we can dive into those kind of three buckets. I think on the first one, as you mentioned, let's just focus on the adjustments. We can move to sort of the the liability perspective. But on the adjustments, what are the most important areas that you see on these deals? And also we'll get into working capital. And you can, tie those together. But what are the most important areas that you examine as a top five, or just to give those listening a perspective on problem areas that you see in these SMB deals specifically?
Yeah, there's all sorts of different adjustments we make. But with these small deals in particular, I'd say revenue recognition is a pretty common one that we see issues with. So um, most small businesses, right, they're doing all their accounting on a cash basis because that's what it works for tax purposes, and they don't have any debt in their business, so they have $500,000 in the bank or $1 million in the bank. They don't really need to care as much about their cash flow, so cash basis just works fine for them. They're not really worried about the ebbs and flows that you might have with a longer cash conversion cycle. So they're just booking revenue as soon as the cash comes in, and especially if there's some project type businesses where they're getting a deposit down, they're doing some of the work. There could be a lot of issues in place um, with how they recognize the revenue and adjustments need to be made. You also see just a lot of errors. We had a deal once. This was like kind of like about a year ago now, but um, the company had been taking out loans against their future Square receivables. They use Square as their payment processor, and the bookkeeper just recorded all income from Square as revenue because everything that ever comes in is revenue. But that was actually a loan. So there was like $100,000 that had been taken out as a loan that was all deposited and coded as revenue. And even the seller even paid taxes on some of that, which was the funny part. So there's all sorts of just these errors that are getting made in these financials, especially when there's no audits being done. It's small business owners that don't have a great accounting department. Lots of different corrections need to be made and figured out.
Yeah, with these small businesses, there's not a lot of financial controls in place. A lot of times the owner can be very involved in the business, have their own personal money running through the business, all sorts of things, as Chris knows better than I do. But it's something to look out for. I think what percentage of these deals do you see where there's what we would call a good faith sort of adjustment versus just downright fraud, maybe in this space, just to scare some people out there if it's true. But kind of what percentage of those do you see where, there actually is material changes that need to be made where the
Hmm.
owner might be really misleading people versus just a few things you got to clean up?
I'd say we come in below what the LOI was estimating for EBITDA the majority of the time. I don't know if I could put an exact percentage, um, but there's always something that comes up that we're finding that's going to adjust EBITDA. Usually tell people like assume their LOI in your LOI that when you're assuming what the EBITDA number is that it's going to be light. Like have that built in. If you're not comfortable with it being light by 10 to 15%, you probably shouldn't be submitting that offer. And then if it is within that range, you could probably use that to renegotiate maybe on price, but maybe some other aspects of the deal, like maybe a bigger seller note, more reps and warranties, other things. And if it starts getting beyond that range, that's when you definitely probably want to sit down and either retrade or just walk away. I'd say of the project we work on, 60-ish% have probably closed. Been able to either get through that retrade, 60 to 70% maybe have been able to either get through that retrade and eventually close. The fraud word, it's
First, yeah,
fraud's a big word for sure. It's I'd say most of these deals are definitely have some hair on them and need some adjustments.
we
I
can
would
we can also
consider
call it material impact if fraud makes you
material
uncomfortable.
impact. Yeah,
Yeah,
I'd say 30% maybe have like are getting outside of that like 20% range, like 20% or more adjustment, probably somewhere in that 30% range is happening. Yeah.
yeah, and at least leading to a significant conversation with the seller over, you know, we just got to talk more about this item specifically.
Yeah.
And then I think for some folks out there, what's a basic sort of list of things that you like to see them collect up front? Obviously, most folks focus on 3-year financials and 3 years of tax returns, but from there too, obviously there's very different business models, but other things that from the accounting side, at least that you'll kind of reach out for folks that are in diligence and collecting items from the owner.
Yeah. So first, I would say a lot of these things are difficult to get pre LOI. So most of these requests, you might get a SIM, you might be able to get tax returns pre-LOI, depending on the deal and the sophistication of the deal you're working on. But you're just not going to get a ton of data. But post LOIs, we're going to send out a full request list, and generally we're asking for 3 years plus year to date of financials, and you want to make sure you're getting them monthly. So balance sheets and P&Ls, and we'll always ask for the general ledger detail so we can see the detail behind what's creating those statements. We're going to ask for their bank statements so we can do a proof of cash and tie those financials to bank records. We want income tax returns and payroll tax returns. What makes the whole process a lot easier for everyone involved is if the seller is able to just provide access to their whole accounting system. If they're on a system like QuickBooks, that will eliminate a lot of the back and forth, and 70 to 80% of your request list might be able to get ticked off if they have a reasonably comprehensive QuickBooks file they've been keeping all their data in. Sales by customer, we're going to ask for expenses by vendor. We'll ask for history of the employees and their term and the churn from that perspective as well. I'm probably missing a few, but those are at least the high level of the request list we're asking for.
No, yeah, and that's very helpful for a lot of folks out there, as you mentioned. I think, for their perspective too, just to understand for the next question on your end, what are the biggest mistakes you see buyers make? Is it not bringing you in soon enough? Is it not being forceful enough with the seller on adjustments? What's the biggest mistake that you see first-time buyers making in the diligence process on the accounting side?
Yeah, I think it's really easy to get excited about a deal. And when you're in that search process, you're getting said no to for 2 years, right? Sometimes when you're trying to search to buy a business, or a year or whatever, and it can get really disheartening, and you're trying to win that LOI. And so you're in this sales mode almost to be nice to the seller and try and get them to like you, try and get them to trust that you're the one to run this business. And then you get in this diligence process, and it comes time to ask some tough questions about what's really going on. And it can be easy to shy away from those. And that's where it's helpful to have someone else that can be the bad guy, like me. like
Yeah,
blame.
I wasn't gonna call you the bad guy, but that was gonna be kind of my next thing. Like, you are the bad guy. How do these sellers take it when you get in the mix?
Yeah, and we're very careful. Like, we specialize in these SMB deals where the seller might not be very used to this process, right? You go up higher, there might be a more sophisticated deal team on the sell side, but um, or usually now have a very sophisticated deal team on the sell side when you're buying a business for $1 to $10 million. And so we're very cognizant we have to handle the seller with gloves. We're very nice to them, but at the same time, we really want to protect our clients. We need to make sure we get answers to the questions we need to get answers to. And it can kind of help save the buyer's relationship a little bit with the seller by making us ask some of those tougher questions, and excuse me, save that relationship a little bit. So.
Yeah, and I think you mentioned it there. We do have quite a few folks who come from the MBA world, private equity, et cetera. I think some of them are used to maybe middle market private equity or lower middle market private equity transactions. We also have folks that are doing it for the first time. So just to understand that your team specifically focuses on this SMB space. And for those out there, it definitely, as you mentioned, it's more of a white glove conversation with the owner, because you don't want to ever alienate a seller, but it can be a delicate thing, and delivering the news that they might not be, retiring with the same sale price that they thought going in can be a very difficult conversation.
Mhm.
So, how do you usually help frame that for buyers that are going out to sellers? Obviously, each deal is different, but is it more a matter of fact of, here's the changes, come back to us and let us know what you think? Or do you find yourself on the phone with their accountant often, or how does that exchange usually kind of go down for the actual delivery of the news?
Yeah, definitely like to get on calls. Like, if the seller's not accounting minded, right? We'll always send out our questions ahead of time so they know what we're going to be asking. And oftentimes they say, "Well, I'm not going to know the answers to some of these, so I'm going to bring my accountant," and then we could talk directly with the accountant. Some of these accountants that aren't familiar with a lot of transactions too. Then there's some learning there, but generally they could still be pretty helpful and they know what's going on. It can get a little more difficult if it's a tax firm and you're trying to buy during tax season, but um, generally they could be pretty helpful um, to bridge that gap. When we do find that there is an adjustment large enough where, hey, you're going to really want to think about this deal for our client. We're obviously telling our client first, and it's up to them ultimately how they want to handle it. Generally, what we recommend is they go first talk to that broker and start there, because for the seller, it's a really emotional thing. And the broker's kind of on your side because they don't get paid unless the deal closes. So ultimately, they want the deal to close, and they've usually done a lot more transactions. So as long as you have this report, this QOV that clearly lays out with evidence why the number is different than what was reported. Not in every case, but in a lot of cases, you can keep a lot of that goodwill and then go back to the seller and explain to them, hey, the next buyer is going to find these same things. Um, you know, I would love to still, if you're still interested, I would love to still buy this business, but I need to make this adjustment here to purchase
Yeah.
price or terms or whatever.
And sort of leave the door open there for another conversation in case they have
Yeah.
to come back with their tail between their legs.
Mhm.
On your end, so you offer a variety of services, and I think you offer pre-LOI, as we mentioned, due diligence, and also kind of post. Can you just talk through process a little bit for those out there who are kind of wondering how those different offerings work for your firm and when to contact you? And then third, maybe how long you need for those processes, just to kind of give folks a general idea as they fit you into their due diligence timeline for a deal.
Yeah, so I'm talking to searchers, a bunch of searchers every week in all different stages of their search. Obviously, all of them are pre-LOI, either pre-LOI they're working on a deal and they're trying to submit one in the next week, or they're 6 months out from buying business. And so I love talking to people at any stage in the process, but generally the best time to really start having a conversation is when you do have a live deal and you're really thinking you're going to be submitting LOI. Um, what we can do then, you don't, like I said before, you don't have a ton of data pre-LOI, and it's just not that much you're going to be able to get. But what we can help with is how you can be thinking about working capital and what at least you should be estimating you're going to need for this deal. You could also start looking at what they do propose as some of the adjustments in their sim, give you an idea of gut check where we think that some of those are going to be. If you're calculating DSCR, right, it can help think through some of those things pre-LOI. But really, we get fully engaged post-LOI for the quality of earnings process. QOV is usually the first thing that kicks off after someone gets under LOI, the first diligence process that someone kicks off with, just because it's the most likely to kill the deal. And if you're going to kill the deal, you want to kill it as early as possible. So usually within a few days, if not sooner, of getting under LOI, people kick off the QOV. I generally tell people to budget 4 weeks for that process. If the seller is really responsive and on top of things, we can get it done usually faster. 2 to 3 weeks is definitely possible. But having a buffer and budgeting 4 is good. And then post closing, to say the deal looks good, you end up buying the business. We do offer post closing services where we can help set up new, better accounting processes, because you probably found during the QV process that they didn't have great processes. So now we get to set up better ones. So you got to have accurate books going forward. We help with taxes and tax planning, and we even help some of our clients with fractional CFO services as well.
Yeah, so full life cycle there for those interested in working with Chris and his team. And before we get to Chris, your background and everything, I want to ask you one quick question on the deal side before we get past these questions is working capital.
Mm.
So working capital, for those not out there and learning more about the space or who are in it right now, is a big focus, especially on the quality of earnings side. And I also see it on our end. It's always one of those things hanging out there towards close that maybe people haven't fully addressed. So the number one reason for failed deals is working capital. So Chris, out there, what is your advice to those folks who are trying to understand better what the heck is working capital? How do I think about it in my deal? And obviously they'll come to you for help, but just general guidelines on it.
Yeah. Working capital kills deals all the time. And it's just because the sellers often don't understand it, the buyers don't fully understand it, and then they each have a number in their head of what they think it should be, and it's just so far apart, and they don't talk about it until too late in the process, and then the deal ends up falling apart. So the first thing I think is important is in your LOI, right? Like I said, you don't have access to a ton of data, but you can do at least a high level analysis of where you think working capital probably is going to be, and have the conversation around what that number is with the seller at that stage. So at least you're on the same page. Obviously, it's all subject to diligence, and you're going to put in your LOI, normalized level working capital subject to diligence, but at least be in the same ballpark around where you think that number is going to be. That way, if you come in, you're having in your mind that's going to be 500 grand, and the seller thinks that's 200. Right? You don't find out about that 2 weeks from closing after you spent $30,000 on legal
And months of work and all that fun stuff. Yeah.
exactly. Yeah. So that's the first thing, is have that conversation early. When we're thinking about working capital, for someone that just doesn't understand what it is at all, the way I like to explain it is that it's the whole in your conversion cycle between when you pay for something and when you actually get paid for something. So just like on a really simple timeline in a business that buys inventory and then sells it, you on day 0 you buy inventory. Let's say you have terms with your vendor. On day 30 you actually pay for it. On day 60 you actually get to sell that inventory, and then on day 90, because you have terms with your customer, you actually get paid. So on day 30 you paid for something, on day 90 you got paid for it. You have to have enough working capital to cover that time frame between that cash outlay and then once that cash actually comes back to you. So that's how you can visualize it. And using that same methodology, if you are pre-LOI and you are trying to calculate, okay, well, how much working capital do I need? If you're doing it at a really high level like that, you can calculate, well, how long is that cash conversion cycle? In that case, it's 60 days. You take that 60 days and you multiply it by maybe average sales per day. That can give you a pretty good idea of how big that hole is and how much you're going to need in order to fund operations. There's tons of seasonality that can come into play and different adjustments that might be made to working capital as well in diligence, but at least pre-LOI, that could be a really good, just simple calculation to get you at least in the ballpark.
Yeah, and then for those out there, how do you split the decision between accounts receivable for earned owners? A lot of folks get in this argument with owners, and they say, "I'm buying the company. I should get everything up front for the business plus whatever's coming in the future." Obviously, the seller argues, "I should earn what I've earned so far plus whatever's already signed up for." How do you kind of advise your customer or clients on that, given it's definitely a hot topic sometimes in some of these deals?
Yeah, I really like the analogy of working capital is the gas in the car. And if you buy a car and it doesn't have any gas in it, well, how are you going to get it home, right? When you buy the business, you should be getting delivered a business that has everything it needs for the buyer to operate it, and working capital is needed for you to operate the business. So in some cases, it is okay to leave the working capital with the seller. Then you have to be compensated for it as the buyer. So if the deal needs 500 grand of working capital, and that's the normalized level for this business, you can tell the seller, and sometimes that's easier, especially these small deals, just have them keep it all. But then purchase price needs to be adjusted accordingly. So if you were going to submit 2 million for that deal, now you'd submit an offer of 1.5, but say you get to keep the AR. And sometimes that's a much easier way to approach it, because you can get a lot of brain damage trying to explain working capital to a seller that doesn't really want to understand it. So.
Absolutely. And then, I think just to close up, we'd love to hear more about you. I've been drilling you with questions for 20 minutes. So, we'd love to hear more about your background, your firm, how to contact you best, because I know folks out there are going to want to work with you and, appreciate all your advice.
Yeah. I guess the 2-minute background of the firm, I started the firm about 2 years ago now, just about. We're niched around helping people that are acquiring small businesses. So we help with that diligence pre-acquisition. We've done about 50 or so QOVs on these SBA funded deals in the last 12 months. So we're very active in the space. We're a team of 9, and yeah, I guess that's the short of it anyway. So.
Yeah, and then for your background, what did you do prior to starting up the firm?
Yeah, right before I started the firm, I was a corporate controller for a PE-backed cheese manufacturer out here in Wisconsin. We're rolling up a few cheese manufacturers in the area, and it was while I was there that I started my business. I actually wanted to search and buy myself. I tried to search right after college. I was working on buying a wrestling camp. I was a wrestler in college, and that deal ultimately didn't work out because of COVID. COVID didn't make wrestling very easy, but I always
Tough
loved
sport
the
for
idea.
COVID.
Yeah, I always loved the idea of acquiring a small business because I had a good job. I was making really good money, especially for my age, and um, but I always had that itch to be an entrepreneur, and I didn't know exactly how I'd be able to do that. And I think that's the same boat that a lot of my clients are in, is that they come out of school with this good MBA, and they can go make 200 grand a year, pretty quickly in industry or at PE or whatever, or more, and but they have this itch to be a business owner, and it's a big risk to go and start with zero. Right now, your salary is zero, and you have to make up to get to replace your salary, plus compensate yourself for the risk and build this business, and the risk of failure. So the great thing about acquiring is that you you can buy a business that can then pay yourself the salary and hopefully have some left over where now you can be compensated for the risk you're taking, plus have enough money to grow the business and reinvest, and now you can actually be an entrepreneur. So that's what got me really interested in the space and wanting to serve that niche. And I was lucky enough where it took off pretty quickly, and there's been a need, and we'll be able to grow the firm from there. So
Well, there you have it, folks. Chris Barrett from Midwest CPA. We'll put on a little thing here at the end for their website and contact info. But Chris, thanks so much for taking the time. Really appreciate it, for answering questions out there for those who have questions around the accounting world. And probably have you on again soon because I'm sure you'll get 1,000 questions. But thanks so much.
awesome. Thanks for having me. This was great.
Yep. Talk to you soon.
Thank you.